I hope you've heard that. I'm joined today by Claire Astley, who's one of my colleagues and a director in the tax team here at PM+M. Claire manages our team of corporate tax experts and is very much a specialist in corporate restructuring. Claire's advised on a number of EOTs in recent years and is also heavily involved in tax aspects of restructuring, including corporate groups, mergers and acquisitions, disposals, and international tax. And Claire's a highly regarded specialist in dealing with tax aspects of demergers. Richard Robinson manages Napthens corporate team in East Lancashire and is a member of the executive board. And Richard deals with a range of corporate work, including acquisitions and disposals, equity fundraisings and investments, reorganisations and restructures, joint ventures and startups, and of course, EOTs. Keith heads up Napthens corporate team in Preston. Keith's also a member of the executive board at Napthens, and he brings commercial expertise in advising and working with businesses at board level. Keith and his team undertake a wide range of corporate and commercial work for clients, including private equity, backed businesses, owner-managed businesses, banks, financial institutions, individual shareholders, venture capitalists, and management teams. And both Keith and Richard are ranked in that well-known legal services guide, the Legal 500, as leading individuals. So that's enough about us. The reason that we're all here this morning is to talk to you about EOTs. Now, there's a range of information out there that's freely accessible, perhaps online, either through websites, forums. If you're very brave, perhaps ChatGPT, although that won't tell you anything beyond September 2021. And always you've got the bloke in the pub too. So not necessarily the most reliable of sources. But between us, I'd like to think that our firms, well, we certainly have dealt with a number of EOT transitions in recent years. So we've got that experience, not only of the transactional side of things and how things work in that respect, but we've also kind of seen the stuff around the edges. So the less transactional stuff, let's say, how is this actually going to work in practice? What happens when I go, when I've been paid out? Can I actually go? Is it the right thing for the business? How are things post-sale? Those kinds of questions. So we've seen those and we'll address some of those today. So I'm hoping and guessing that many of us on the call today have an awareness of what EOTs are and why they might be considered an attractive structure for a business. They are proven to drive engagement of people and can be seen as particularly attractive because of some of the generous tax advantages that are associated with them. There has been some concern that some of those benefits might be restricted because the revenue announced earlier in the year that they were going to be consulting on the effectiveness of EOTs later this year. And in fact, they've timed their consultation perfectly for us because they officially opened it last week and they've published some material on their website covering the areas that they specifically want to consult with business owners on, as well as tax advisors like ourselves, consultants, lawyers, and other non-governmental organisations. So the consultation period is going to run for the next 9 weeks or so. And we've got more of an idea now of what we're going to be consulting on, and Claire will touch on that shortly. And hopefully kind of we'll have a bit more of an understanding as to what EOTs might look like in the future. Thankfully, it looks like they are going to stay around for some time, albeit we might see some tweaks to the way in which they operate and the way that the tax benefits might look. So that's enough from me. As I said, we're recording now. So I think let's kick off with some questions to the panel who can hopefully all hear me, having waffled on for the past 5 minutes. So Keith, I'm going to come to you first. Can you start by please telling us, giving us an introduction, what is an EOT, and shine some light on what is meant by the phrase succession through employee ownership?
Yeah, thanks, Roger. Hopefully you can all hear me. Morning, everyone. I want to start by just mentioning what we mean by succession to employee ownership. So in a nutshell, that means that the employees take a majority stake, majority control of a trading company. But for practical reasons, you can probably imagine if you've got 300 members of staff, it's not practical for each of them to hold a share. And so the idea of an EOT stands for Employee Ownership Trust. And that's a type of employee benefit trust where you've got a trustee, often a trustee company, which is structured as a body corporate, a company without shareholders often. and it holds assets, i.e. the shares in the trading company, for the benefit of the employees. And it's entitled to deal with those shares, receive dividends from those shares, receive capital return for those shares. But all of its assets that it holds are for the benefit of, broadly speaking, all the company's employees, not just a specific group, but all of them. That's the sort of key feature of an employee ownership trust. And the idea about EOTs, they came about due to a review, the Nuttall review in 2012, which said that, as Roger's already alluded to, there was a sense that companies were more successful where there was a long-term employee buy-in to the business, where the culture was very much that the staff had an investment indirectly in the company. And so for that reason, the EOT structure and the relevant tax legislation changes were brought into effect to sort of encourage business owners to look at EOTs, look at the transition to their employees as being an alternative to what would typically be an exit value of a trade sale, or even a winding up of the company. Very briefly, this transaction, the first question people often ask is, well, that's all fine, but how does the trustee pay for it? And the answer is that the trustee would buy the shares like any other purchaser of shares in a typical transaction. But rather than pay the purchase price all in one go on completion of the sale, the typical EOT structure has the trustee use a combination of cash in the company, sometimes some bank debt, if bank debt is available. But for the most part, the lion's share of the purchase price is left outstanding and paid over a period of time, often a number of years, basically out of the future profits of the company. Right. So, broadly speaking, an EOT structure.
Okay, so it's a kind of an alternative way to sell your business if your traditional routes of MBO or trade sale to a VC, if they're perhaps off the table, I suppose.
Yeah, or if it's important for you that, from a philanthropic perspective, you see the ownership of the company transitioning to the employees to the right.
Okay, great, thanks. Right, Richard, hope you can hear me. Are you there, Richard?
It's still here, Roger.
Right, okay. So I'm going to come to you then, Richard. So can you just give us an outline what your perception is of how prevalent employee ownership type deals are at the moment? Are they a sensible alternative to, as we've said, a management buyout or a family buyout, or, those traditional routes of exit?
Yeah, Roger. I am here and I am fully closed. I'm not sitting in my pajamas somewhere, so apologies. For some reason, my video isn't working, but that I think is to everyone's benefit. There's probably many people out there wishing it had been broken through lockdown as well. But yes, in short, the answer is yes, Roger. They are a sensible alternative. Often not talked about enough when people are talking about exit planning, to be honest. I mean, they've been around for a long time now, and I suppose there's probably no excuse for that, but perhaps one of the main benefits of looking at EOTs is the timing. It's a very different transaction to an arm's length transaction. The familiarity of the vendor with the purchasing entity means that you can dispense with some of the things that might delay a process, so warranties, due diligence. Those areas are less relevant to an EOT transaction, so it can provide a viable solution. In terms of prevalence, I still think there's work to be done on educating probably the market and probably the advisor community. If you've never done an EOT before, you're probably not going to advise your clients to do it, which is perhaps one explanation why they're not as prevalent or as discussed as much as they should be. But certainly our advice would be that when you're looking at exit planning, it's definitely something. The tax advantages, which we'll come on to later, are very attractive. Some of the cultural reasons for doing it are very attractive. And for the right entity, an EOT is definitely something that should be on the table. Okay, great. So it sounds like perhaps a less sort of painful experience that a seller would have to go through as compared to, where you've got two sides, more of a friendly deal, that kind of thing. Yeah, absolutely. I mean, clearly when you've got an arm's length transaction, whilst there might be a common goal, you're coming at it from two different ends, and there's an element of risk there, buying and selling companies, and an element where there is perhaps not the relationship and trust you've got with an EOT. So in theory, it's a much smoother transaction, and can be done, without some of the stress and some of the costs of a classic third-party transaction. Okay. Before we just move on to the next question, I should have said at the start, we're going to invite some questions and answers at the end of the EOT. So
I don't know if that facility's opened. I've just received the message saying it's not. So I don't know if somebody can just have a look at that just to see if we can take questions throughout, and then we'll address those at the end. So thanks, Richard, for that. Keith, I'm just going to come back to you then. Just touch upon why, some reasons why shareholders and management might find a transition to employee ownership so appealing, please.
Yeah, sure. I think from the shareholders' perspective, first of all, so we're talking about the existing owners of the company, there's an element of control here that maybe doesn't feature quite as much in a trade sale. So, sometimes out of necessity, someone might have had a company on the market for a while, or just really not been able to find the right buyer at the right price. And there's a sense that really when you're structuring an EOT transaction, there are third parties involved, there are potentially non-execs who need to get involved and so on. But broadly speaking, the transaction can almost be done by the shareholders by themselves almost, provided there's the right communication lines with the staff and so on. So that's one of the main benefits. There's obviously the tax benefit, which I won't steal Claire's thunder. I'll let her talk about that in a few minutes. And I suppose from the owner's perspective, there's also the ability to, you've got to sell a 51% stake or a 50% plus stake. You can retain a stake in the business. So there's an opportunity for you to almost have this partnership structure where the EOT, the trust, takes a 51% stake or more, and you take some sort of like 25%, 10% minority stake. Gives you an opportunity to sort of make it feel like it's still a joint venture. It's the original founder's still around. And there's also an opportunity to sort of share in the growth value of the company. So in the future, the remaining, minority stake could be bought out by the EOT. From management's perspective, the benefits are really, I suppose, looking at how to incentivize staff and how to get more out of your people. And if you've got the wherewithal to pay, a tax-free bonus of, £3,600 a year, that's helpful. It can help the culture of the business, I guess, if your members of staff, if your team have a stake in the business. And I suppose the benefit from the staff's perspective is no one's really got to find the money out of their own pockets. So unlike a management buyout, for instance, where there could be a possibility that management buying the company would have to either put the cash in or give personal guarantees to third-party funders or to the seller, that really doesn't feature in quite the same way. And the benefit of an EOT is that whilst you transfer a majority stake, it doesn't have to be all the shares held by the EOT. So you can still sort of create some sort of management incentive share plan where you say, well, okay, the majority shares are for the benefit of all the employees. Maybe there's, 25% left with the founders, the original shareholders, but there might still be an element of a significant minority stake, which could be for the senior management team. So if you've got 3 or 4 individuals, you need to incentivize in a different way. There's still a possibility of giving them direct shareholdings outside of the EOT plan. Which means that, there's legal mechanics, how they realize that value in the future. That's all part of the negotiation, but there's still a capital opportunity, a capital return available for senior management, which sort of addresses that challenge, I think, which in some ways features in EOT land, which is it's fine to sort of incentivize all the staff, but how do you incentivize the people who are really kind of like on the board, the exec directors, the senior management? How do you incentivize those guys?
Yeah, no, that's a good point. And there's that whole piece around kind of equality of reward amongst the employee base as a whole. And I suppose if you can offer EMI options or something like that, then that's an additional kind of carrot for those individuals. Thanks, Keith. So Claire, if I'll come to you next, please. I mean, we've talked about the tax advantages. That's kind of the headline piece that people tend to pick up on. Can you just tell us what those tax breaks look like from a seller's perspective, please?
Yeah, no problem. Good morning, everyone. The tax advantages, I think, are probably the biggest draw, really, of an EOT. The key benefit is that provided certain conditions are met, the vendors are able to sell to an EOT with no capital gains tax liability at all. In effect, the sale takes place on a no gain, no loss basis. As I said, there are conditions that are needed to achieve this, and these conditions are: there's a trading requirement. So the company has to be a trading company or the holding company of a trading group. A company that has significant cash, land, or other investments may not be a trading company. There's the all-employee benefit requirement. So that, as mentioned before, the trust needs to be set up for the benefit of all the employees who work for the company. There's an equality requirement. So the EOT not only needs to benefit all the employees, it needs to be done on the same terms. So the benefits can't be skewed towards a specific group of people, such as the directors. There's a controlling interest requirement. So the trust needs to take a controlling interest in the company. So it needs to own over 50% of the share capital, over 50% of the voting rights, 50% profits entitlement, 50% of the assets on a winding up. So for capital gains tax purposes, the trust can't have a controlling interest immediately before the year in which the disposal takes place, but it does need to meet this condition by the end of that tax year. There's also a limited participation requirement. Now, this is where the transferor has an interest of 5% or more of the company shares before the sale to the EOT, and that's most vendors would have that. There's an additional requirement, and this is that the number of employees that hold 5% of the shares after the sale to the trust must not exceed 2/5 of the workforce. So if all those conditions are met, the sale should qualify for 100% relief from capital gains tax. Although it is necessary for the vendor to make a claim to HMRC for this relief, it doesn't just happen automatically. Finally, there are some inheritance tax reliefs for the trust itself. There's an IHT charging regime that applies to most trusts, where they're subject to IHT every 10 years on the value of the assets owned by the trust. So in this case, the trust would own the shares in the trading company. And there are charges also where the trust appoints assets to beneficiaries, but special provisions apply to exempt EOTs from these types of charges. So the ownership of the shares by the trust is a really tax efficient option.
Okay, thanks, Claire. So just picking up on a couple of those points then on the limited participation thing and the 2/5 rule, I guess that kind of suggests that it does mean that EOTs might not necessarily work for the smallest of businesses, you know, if the sellers are going to make up a significant proportion of the workforce afterwards. So you can kind of see a position where you've got a relatively low number of employees where you're kind of on the cusp of possibly qualifying or possibly not. And then in terms of the controlling interest stake that you mentioned, that kind of gives a window, doesn't it, for that tax-free sale. It's effectively the tax year in which the control's taken, isn't it? Is that
Yeah,
right?
that's right. Yeah, it's the tax year. So you got to take control in that first tax year.
Okay, great. Thank you. Okay, so this all sounds fantastic. So a tax-free sale of your shares to a new trust. The objective of that trust is to manage its assets, so the shares in the company that it's just bought, for the benefit of the workforce of that company, whoever might make up that workforce at any given time. So we've got this new trust, the Employee Ownership Trust, that you people at Napthens have drafted for us, ready to buy the company. There's one thing that's missing, one thing that it needs to do that. Keith, you touched on it at the start, but I'm going to come to you, Richard, for a bit more detail on that. How are these transactions funded generally?
Yeah, well, as you say, Keith sort of went through some of this a little bit at the start, but effectively the trust co doesn't have any money. So typically these transactions are funded in a combination of cash on day one and or deferred consideration. So obviously the deferred consideration is generated by the trading company, and that gets pushed up into the trust company to distribute out. Funding is available, Roger. There are banks that will fund EOTs. And typically, again, what would happen is that the target entity would borrow the money and then move that money up into the trust company to pay out the consideration.
Into the trust, isn't it? It's into the trust.
Yes, up into the trust. Whether that is structured as mostly deferred or not depends on the circumstances. So when you're looking at this, clearly your advisors will have a look at what value you place on it and how that's funded. But there are options out there to get external funding as well as using the balance sheet of the target entity.
Okay. So banks are out there offering, they understand what these things are.
Yes, some of the main clearing banks do this. There are other smaller banks that will fund it as well. So again, it's increasingly common, and there are a couple of prevalent players in the market. So when you're looking at this, have a chat to your advisors. They'll certainly be able to steer you in the direction. It's not particularly novel, although I think it's fair to say still probably a growing market. But there are a number of players in there that will be able to fund it.
Okay, and then I suppose in terms of funding, and we'll come on to this, there's kind of that fine line, isn't there, to walk in terms of the seller wants to get as much as they can, but if they're being paid out via deferred, you don't want to put the the business into kind of financial difficulty by kind of overstretching it, do you? You're trying to incentivize, but you're also trying to get paid at the same time.
Yeah, there's always a balance, and I suppose probably the culture of EOTs to a certain degree attracts people who are probably not looking to squeeze every last penny out of the business.
Yeah.
So to a certain degree, if that's your goal, you might be looking at a different form of exit strategy. And clearly, as with any deferred consideration, it's quite important you get paid that. So leaving the cupboard bare and not allowing the entity you're exiting to satisfy that is a bit of an own goal. But again, Roger, as with all these things, you know, getting the right advisory team around you will smooth over these issues. They can answer all these questions, and they can make sure that those schoolboy errors are not made. So again, the key thing is always with these things is making sure that you're getting some people around you who've done it before and can answer these questions.
Yeah, and in terms of value, we should stress that the sale can take place at market value tax-free, so full market value tax-free. But also it can, as you kind of alluded to there, Richard, you can sell for less if you want, and there's no kind of, the only downside is that there's less money in your pocket. But you might see a more incentivized workforce. You know, if you were somewhere in a region perhaps slightly less than market value, I suppose.
Yeah, it comes back to that point, Roger, when you're looking at an EOT, you know, a lot of this is why are we doing this? What are we trying to get out of it? And there are some things that an EOT offers that other exit strategies perhaps don't. So that will come out in those discussions.
Okay, great. Right.
I think it's also worth,
go on, Keith, go on.
I was going to say one thing that's worth mentioning, the bit that's probably the trickiest bit to negotiate actually in the legal documentation is often the deferred consideration, because there's usually a drop dead date where the seller says, look, by this point I expect to have my money. But, you know, does that look like an annual set of installments? Does it look like, well, we'll pay you whenever we've got the cash available to do so? So sometimes you have to negotiate maybe like cash sweep mechanisms that say that, well, we'll pay you this much, but if there's actually more cash available by reference to, you know, a formula of management accounts, you know, the trustee will pay you more. The key thing to bear in mind is that the trust is only ever going to be funded by the profits in the company. And just like a distribution dividend, the company's going to have available profits on its balance sheet, distributable reserves, to be able to cash out into the trustee. So you're always going to have that mechanism.
There's a tax issue there, which Claire will come on to hopefully shortly, and that's kind of been picked up as part of this consultation. So we'll talk on that shortly. So, so Keith, just whilst you're kind of talking now, I'm going to stick with you if that's okay. So owners who are selling might feel, I mean, they will be losing control. That's one of the criteria. They're going to be losing control of the business, but they might feel that they're losing control of the business in a way that might perhaps put future performance of the business at risk, particularly, you know, if those payments that we talked about are dependent on future profitability and cash flow. Could be a concern. Is it reasonable for exiting shareholders to be concerned about that kind of thing?
I suppose many owners of companies that, you know, there's always that challenge around them, you know, when they cede control to a management team, or if they sell to a trade buyer and stay on the business, they've got to get their head around the fact it's not their company anymore in terms of, you know, 51% ownership. And losing control is a key feature of EOTs. It's a requirement of tax legislation. But I think there's an important point around you needn't be invisible as an owner, and still retain a presence both at the trading company level, and you can also, you know, retain or have a board directorship on the EOT trust company right at the top of the tree. Now, you won't have majority control at that level. You won't be able to control that board, but you will have a say. And the important thing about EOTs, I think, is also the EOT trust board, and this is maybe something that's, you know, a common misconception, is they don't run the business day to day. You know, the EOT trust board is often meeting once a quarter. It's more of a reporting exercise from the trading company to understand what's going on. There may be some key decisions where the EOT trust would want the ability to say yes or no, you can or can't do that, making an acquisition, taking on third-party borrowings and so on. But for the most part, it's an information gathering exercise and it's an understanding exercise, because those employees, for instance, who may well be elected to the board of the trust, which I can come on to in a second, you know, the idea is that they are not running the business going forward. It's still the trust, so it's still the trading company's board of directors stays in place, and that can still include the original shareholders. So that's the important part of it. The key is to choose the EOT board carefully. It's ultimately controlling the company that's got 51% of the shares, who's on that board. And in our experience, a well-balanced board will include a couple of employee directors, i.e. people who are nominated and appointed out of the pool of general employees of the business to sit on the board, understand what's going on. One or more of the founders, if there's only one shareholder, the original shareholder, or if there are more than one, a couple of those. And then to create a balance, our advice is to look for a non-exec, try and get a non-exec on the board who has got some experience in EOTs, experience of balancing the interests of previous owners and future management and future employees, and can also sort of manage the employees as well. Because to be fair to the employees, these guys may have been near the board of a company before, never mind an EOT. And for them, it's completely foreign territory. So to have a non-exec around to sort of assist in that sort of education process, I think is really important. If you've got that right, then you should be okay. And the final point, I think, is that it's also possible, subject to tax advice, to put stuff in put provisions in the documentation that say that as part of the sale contract, when the seller sells the shares, there will be certain things that would stop the company from doing without that seller's consent. Just almost like a sort of veto minority protection right.
Yeah. Just
make sure that the company doesn't do something going forward, which, for instance, is going to scupper the tax treatment in the first 12 months. So it's not a question. It's all in the hands of the trust, and you can't do anything. In practice speaking, you've still got to say.
So typically, you'd see some kind of indemnity in there saying that if the trustees did something that cocked up the tax treatment for the seller, there'd be some kind of way that they could be recompensed for that, I'm guessing.
Yeah, the way I'd normally do it, I'd simple provisions say, the buyer, the trustee, will procure the company, and it will not do any of the following.
Right. Okay. Yeah.
And so it's a contractual right to sue if, or you could even look for injunctive relief and go to court and force them to stop doing it.
So just to, we've kind of touched on deferred consideration partly there and partly in the previous question. I'm just looking through the questions that are dropping in now. It's nice that we've got some questions coming through, and it's probably better to pick some of those up as we go through. So one of the questions is around deferred consideration, and what typical period might that be paid over?
So I would say it's normal. Well, if you've got a bank funding, let's say, the bank may want to be paid back over sort of 3 or 4 years, maybe.
Yeah.
Every likely the bank will want the original shareholder to sign up to some sort of subordination into creditors deed that says that they will not get anything unless either the bank's been paid off or unless the bank's otherwise happy. So you've always got that challenge that you could have to wait for the bank debt to be paid before you can even think about getting it deferred, possibly.
Yeah.
Otherwise, I'd say between 5 and 10 years.
Okay, that's typically what you'd expect to see, perhaps. I guess there's kind of cash flow modelling exercises that need to be done around the edges, but also there's that flexibility of if there's enough there, you can perhaps be paid down earlier.
Yeah, Roger, a lot of people would look at that and say, crikey, that's a long time to defer. But again, it comes back to that point. This is not an unfamiliar seller in a sense, and an unfamiliar buyer. So,
Okay. Like I said, there's questions dropping in quite quickly now, so that's great. So some I'll pick up and some we'll deal with at the end. Keith, you talked about non-executives there. I think the Employee Ownership Association, I think they maintain a list of kind of non-execs who are familiar with employee-owned structures. So these people have got the experience of working in these kinds of businesses. So I suppose if you're looking for somebody suitable for that kind of thing, then the Employee Ownership Association might be a good kind of starting point. So we were lucky enough to have Yogita from the EOA on our last webinar on this topic, Richard. We've talked about the mechanics of how it works in practice, and at the start I said that we were going to talk about some of the kind of less technical stuff, if you will, the benefits for the businesses of actually transitioning. The EOA, the Employee Ownership Association, they talk about things like inclusivity, resilience, sustainability, those kinds of things as being benefits of employee ownership. Can you just talk about what your experience is in terms of, you've done the deal, sales completed, the trust owns the business. In practice, how does employee ownership actually work in terms of the benefits that it brings for companies once they've kind of done that transition?
Yeah, I think if we had the AOA on, they would rightly highlight the positive sides, of which, you know, there are many. And I think that sustainability and sense of ownership is one that can tend to work better in some businesses than others. So people businesses, or businesses where there is a sort of high level of employee engagement, are kind of classic candidates for this sort of situation. Other businesses may not actually drive that benefit, and may lose actually something by spreading the ownership across everybody. It would maybe lose a bit of focus and drive of a tight management team that maybe have some individual incentives. So I think, as always, it's not a one size fits all. So if you have a very people orientated business with a culture that would lend itself to shared ownership, then this is obviously going to work very well. If there's a business where employee engagement is not so critical, it's probably less appealing. There's a question, I think, on the chat around getting out of these things as well, and that's another thing to think about. You know,
I'll come on to that shortly, if that's okay, on the exit piece, if that's all right.
Yeah, so I guess what we'd say is, again, as part of a discussion, employee ownership is not a new thing. I mean, it's been around in various guises for many, many years preceding this legislation. And, you know, there are companies out there that have been doing this for a long, long time, very, very successfully. Those businesses tend to be businesses where employee engagement and the importance of the individual employees drives the culture of the business. So if that's the kind of business you've got, then this cultural fit. Clearly, you know, some of the drivers are around the tax and all the rest of it. But if you're looking at that kind of succession planning and longevity, it's a good model.
Yeah, and I suppose there's kind of a run up to this, isn't there? It's not something you can't just kind of come and say, I've heard about this, I want to sell it to my employees. There's a whole kind of build up to that, isn't there?
What we tend to see with a lot of these businesses is they will take a lot of time talking to other employee ownership trusts and businesses, perhaps, you know, go to some of the EOA conferences, and they might start working groups or actually restructuring their business and changing their ownership and management style a little bit so that the business is culturally better prepared. I mean, we have heard stories where people have just sort of had a big bang, and the thing has been problematic because, you know, the business wasn't ready for that level of engagement. And similarly, some businesses do this, and all the employees suddenly think they can walk into the managing director's office and, you know, get a car park space by reception, etc. And that clearly doesn't work. So there's an education piece for owners and whether this is the right structure. There is, if you're doing it well, also probably an education piece for staff so that they're ready for the transition. But as I say, businesses will lend themselves well to this model. Other businesses perhaps less so.
Yeah, great. All right, thanks. Thanks, Richard. So just coming on to the employees and the benefits for employees, Claire, I'm just going to come over to you now. So can you just talk briefly about the tax benefits that EOTs might offer for employees?
Yeah, sure. As well as the capital gains tax and inheritance tax exemptions we've already discussed, there is an income tax relief for the employees themselves. Broader, this means that tax-free bonuses can be paid to employees. There's very similar conditions applying to this as we discussed for the capital gains tax reliefs earlier. Key ones are that it must be a trading company. As mentioned, the EOT needs to have held a controlling stake for 12 months, and all employees must be able to participate in the bonus scheme. You can exclude newly recruited employees, and also you can exclude employees on disciplinary grounds if you needed to. The equality amongst employees doesn't mean that all the employees must receive equal amounts of the bonus. There can be some variation in respect of remuneration, length of service, hours worked. The exemption from income tax, it applies to bonus payments for up to £3,600 per employee per year. National insurance contributions are still payable, and the bonuses are paid through the payroll as usual. So it's not by the trust, it's by the company itself.
Okay, great. So it's not a flat 3,600 to everybody. You can kind of manipulate that number, but still fall into those equality requirements. Right, okay. Thank you. I think we'll talk in a bit about the consultation, but there's some potential relaxation of the rules around there, isn't there, in terms of directors. Brilliant. Right, thanks for that, Claire. Keith, we've had a question around leaving EOTs. Let me just have a look. what happens, this is an anonymous attendee, down the line when the business is owned by the EOT, can there be a further sale?
Yeah, yes, they can. You know, the trustees hold the shares, they've got the power to sell the shares if they wish to do so. I think there's a couple of things coming out of this, I suppose. One is legally it's possible. The query, the buyer, he's got to get his head around the fact that when they buy the company, they'll be paying the share proceeds to the trust, and the trust will then be holding those assets, that cash, for the benefit of all the staff, and you know, paying that out to the staff, you know, in line with the principles as adopted for, you know, applying the proceeds on the equality basis or using equality treatments. In other words, based upon, you know, your length of service, your hours worked, and your level of remuneration. Now, whichever way you cut it, everyone in the company, every employee's got to receive something. It's not possible for someone to receive nothing. So you're going to pay a lot of cash to the trust, and some of that is going to filter down. All of it's going to filter down one way or another to the staff in their, you know, pots. You've got to bear in mind, I suppose, that if you're paying a significant sum of money to a company which has maybe not a huge number of staff, and they receive a decent payout, how incentivized are they going to be to then work for you going forward? So that's a sort of thought for, you know, the buyer.
So on an extreme case, you could kind of see EOT selling to a buyer, EOT or beneficiaries, i.e. employees of that business, getting a load of cash in their pocket, and then perhaps thinking, do you know what, I've got enough now, I'm done with work, and the whole thing falling into place.
You've put it a lot more succinctly than the lawyer did. That's it. Exactly. So that's one thing for the buyer to bear in mind, and might make it more of a more tricky to sell than a sort of private company. Yeah. You've also got to bear in mind from the trustees' perspective, they're going to be very careful that they're making the right decision to sell the shares. You know, that again, it helps when you've got a non-exec on board, but if you've got an offer for the company, then you really need to be sure it's a great offer, because obviously your duties to the employees, the beneficiaries, including, I hasten to add, some ex-employees. So anyone who's been an employee up to 2 years before you sell is also brought into the net.
Okay.
And you know, you've got to be just alive to the fact that if you're deciding to sell the company, it's got to be for an amount which the employees aren't going to have a problem with. Now, you know, the chances of employees bringing claims probably not that likely, but you could get some disgruntled people who feel, well, actually, this was meant to be for my long-term benefit. This was meant to be a cultural change where I was invested in the company, albeit via the trust. I was never expecting for this to be sold. I thought it would always be the employees. So the trustees have got duties, and they've just got to bear in mind that there is a sort of slight risk element, you know, coming out of that decision to sell.
Yes, it's going to be an unusual scenario, isn't it, for an EOT to
sell. Yeah, and it was never really the intention, I think,
no.
that you then flip it on. It was always the intention that this would be a sort of long-term project.
Yeah.
And I think you've also then got to bear in mind the challenge, and it's related to the point I mentioned earlier about how do you incentivize management. So yeah, okay, if you're never going to sell because you can't sell because that's really not the structure, how do you make sure the people in the business who are actually driving the bus feel suitably rewarded? Because ultimately those people will never have control of the company.
Yeah.
And so that's why things like EMI share options and just understanding what drives your senior management. If you own a business, you're thinking about an EOT and you're going to sell for 10 million quid, but to get your £8 million deferred, you're relying upon 2 or 3 key managers. Are those people going to be incentivized enough to get you that £8 million over the next 5 to 10 years? That's a really, really important point to bear in mind.
Yeah. Claire, if the EOT does sell the company, what are the tax impacts of that?
As Keith mentioned, EOTs, they're really designed to be a long-term plan rather than a short-term option. And the tax consequences of leaving an EOT are not particularly favourable. I suspect that's the deliberate policy.
Yeah.
So in this situation, the trust would realise a capital gain on the disposal of its shares in the company. As we mentioned right at the beginning, the trust will have acquired the shares on a no gain, no loss basis from the original shareholders. So this means that the trust will have inherited the shareholders' original base cost for tax purposes, even though it's likely to have paid significantly more for the shares on purchase. So consequently, the gain on disposal of the shares by the trust will effectively comprise of the original gain that was tax-free when the shareholders sold the shares to the trust and any additional growth in value since the date of acquisition. So The capital gains tax rate for trusts is 20%. So it could represent a significant tax liability on a sale.
Yeah, and that's the current rate, isn't it, for CGT?
Yes, it is. Yes.
So I mean, that could move too. So really, it's kind of original base cost less, or proceeds less original base cost. So there's a big gain there, isn't there? Yeah. So whilst you're speaking, Claire, I'm going to stay with you. So we've talked about one of the principal drivers behind popularity of EOTs, perhaps kind of wrongly, is people see the tax efficiencies and think, brilliant, this is how I'm going to get out. That's what we talk to clients about, the tax efficiencies, because that's our job to talk to them about that. Although it comes with a health warning, we don't go out and sell EOTs by any means. We and you at Napthens, we want to be sure it's the right thing to do before you jump into this, that you're doing it for the right reasons. Are the revenue looking at these tax efficiencies as part of this consultation process that they're going through at the moment?
They are, yeah, and as you said, they launched the consultation last week, so they set out the sort of issues they wanted to look at, and we've been through it, and it's generally really good news because the consultation does make it clear that employee ownership structure is still really encouraged by the government. They've just touched on a few issues that they want to kind of tweak, I think, just to make things a bit clearer. One of these is in respect to trustee issues. So the government are considering whether there should be a limit on the number of trustees of an EOT that can be made up of the former owners of the business or anyone connected with them. So I think they're looking to ensure that a sale to an EOT does in fact result in a meaningful change for the employees, and that the former owners don't still effectively control the EOT. Well, the former owners can still be on the trustee board.
Yeah.
They're looking at the trustee tax residency, because there's currently a potential loophole which can enable an EOT to be located offshore and thus potentially escape capital gains tax in the event that a disqualifying event or a future sale occurs. So HMRC are looking to close that loophole down.
So a disqualifying event being something like the loss of controlling interest,
yes,
not doing the equality, all of those kinds of things.
Yes, there's a whole list of things that they could fall foul of.
Yeah, okay.
They're looking at the funding issues. This was touched upon earlier, because we said how in many cases sellers are paid for their shares over a period of time, and they need to use funds generated by the company. So the company needs to generate the funds, transfer those funds up to the trust before the trust can pay out to the seller. Now, at the moment, HMRC practice is for these contributions from the company to the trust to be treated as non-taxable, but there's no actual law setting that out. So a lot of cases, advisors will write to HMRC to get clearance to make sure it's going to happen, and there's just that bit of uncertainty. But HMRC have said in the consultation that they're intending to put into practice a legislation which will make it clear that those contributions up to the trust and are tax-free. So that'd be a welcome change, I think. Yeah. The other area they're looking at is the bonus payments to the employees. As we mentioned, one of the benefits of the EOT is the ability for the company to make tax-free bonuses up to £3,600 a year. HMRC are looking to potentially relax slightly the strict requirements around treating all the employees equally. I think the thought is, looking at this, is that they may relax it so that the company can pay bonus payments to employees, but not necessarily to directors at the same time. So there could possibly be a split, that they could just incentivize employees rather than the directors. So it's a bit unclear exactly what that's going to entail yet. Don't think they'll be able to incentivize directors and not employees. It was more being able to exclude the directors from that payment.
Yeah, I suppose if you've got fewer people to incentivize or fewer people that you have to incentivize, that perhaps makes it slightly easier for the company. So I mean, they all sound really like sensible suggestions, I think. So I think as a firm, we're generally welcoming of the suggestions and the areas that the revenue are looking to consult into. It will be interesting to see if the outcome of the consultation process kind of is as tightly drawn as the things that they've talked about there, or whether they just kind of do something totally different. And they're not going to pull the rug, but no, they could. No. I think we've experienced in the past where they've said they're going to consult on something and then they just come up with something totally different. So anyway, yeah. I mean, at the start we talked about Lancashire and how we're kind of tightly rooted in Lancashire as firms PM+M and Napthens. Keith and Richard, how relevant is employee ownership to the Lancashire market? Is it prevalent? Are you seeing transitions at the moment?
Yes, I suppose is the answer. Keith's nodding. I'm nodding too, although you can't see it.
Yeah.
We are, Roger. We've seen it increase probably, Keith, I'd say over the last 18 months, 2 years particularly. We've got a number of live transactions on at the moment. We don't expect that to stop.
Yeah.
As you say, the government consultation looks like if anything, an endorsement that this is going to continue, and we don't see there being less appetite for it. There are, as always, reasons to do it and reasons not to do it. But it should certainly be a part of the discussion when you're looking at succession and exiting any business.
Yeah, so it's one of those kind of what was your traditional exit routes, your MBO, your family buyout, sale to VC, sale to trade. You should now be adding on EOT as one of those considerations, shouldn't you?
Yeah, and I think sorry, Keith, you go.
Oh, you go. Sorry.
I was just going to say the Lancashire market is not dissimilar to lots of markets around the country. Hard-working northern folk do not do things that are typically racy or problematic. They tend to look after their workforce as well. And so, if that is part of your criteria, which often it is, the EOT is a good option. And as I say, some of the other options on the table do bring other challenges. So it's in the toolbox. We're seeing a lot of it. We expect to see more. As always, pick up the phone, have a conversation, look into it, and see if it's right for you.
Yeah, I suppose even just kind of consider it and strike it off a list. At least you've considered it, because there are clear benefits of doing it. Keith, did you have anything else to add on that?
No, I think it probably is to echo something Richard said earlier, which is it suits those companies who've got, I suppose, more of a people business. So the types of companies we see do EOTs are often professional services, construction consultancy type businesses, marketing, PR companies, and so on. Anywhere where there's a sort of element of intellectual capital, maybe where the staff are fairly skilled. Companies with a very high degree of staff turnover, probably not so much for them.
Yeah.
But I think one thing is an interesting opportunity for a family business, for instance, where you don't have a next generation coming through. Maybe your management team really don't have the appetite to take it forward. There's no immediate trade sale, or you just don't want a trade sale. Then that's when maybe an EOT will be an interesting option.
Yeah, and it's about, like we said, isn't it, managing that transition, which might take a while. And we've got a point here from Neil Welsh from PM+M. The longer the deferred consideration, the more reassuring it is for the EOT that they are not being abandoned and left to manage a potentially rudderless ship. That's a good point there, Neil.
Well, familiar with Neil making good points, and I suppose the thing is that, and I've seen this recently, where you have a transaction that has gone down a more traditional third-party route and it's not working out. Maybe some of the issues in the marketplace are meaning that actually the value you're receiving, it's not too late to actually say, hang on a minute, maybe we want to just stop this process now and consider alternatives. And certainly we've had a discussion recently on transaction where, for whatever reason, the traditional MBO route was looking like it was marginal. So actually, it's something to not just think about at the start of a transaction. Yeah. During the process, there's always an opportunity to say, hang on a minute, if this is not giving us the outcome we want, maybe we need to revisit that. And if we're seeing, pressures on valuation or the ability to get transactions done over the next 12, 18 months, then this might be something that is a secondary consideration, having dismissed it in the first place. So to keep your options open, I would say, Roger.
Yeah. So just picking up on some of these questions around valuation, somebody's asked, some owners may wonder, is the process of valuing a business for EOT purposes the same as for a conventional sale? So, I mean, I would answer that by saying yes. As we said at the start, it's a market value. The sale can complete at full market value. So it would, for a trading company, typically it's a multiple of profits plus any free cash that's in the business, less any debt. That's typically how you'd value it. There's no actual clearance process for agreeing that share price. Just coming on to one of the questions below, what we typically do is we seek a clearance for the transaction to proceed, because there are some anti-avoidance rules that we ask the revenue to confirm will not apply when we do one of these. And as part and parcel of doing that application to the revenue, we do state what the business is going to be sold for and enclose our kind of workings for that valuation, or our corporate finance team's workings for that valuation. We would always get an independent valuation done, because to the extent that the vendors are paid more than value, any excess would be taxable in their hands as a dividend. So the revenue won't rubber stamp the value, but it does provide a degree of comfort to sellers that, you know, they've told the revenue what they're doing. But I'd kind of hoped that the consultation process might have invited an opportunity to get that value agreed, but it hasn't. So typically with transactions with the revenue, you can't get values agreed until you've done them. I think there's only one case where you can, and that's granting EMI options to employees. So I would have liked to have seen something on that, but we've not seen that. Somebody else has asked, with regards to deferred consideration, is there a standard interest rate that should or can be applied? I mean, from my perspective, the answer to that isn't. If I answer that, the answer to that is no. I guess it comes down to how much pressure you want to put the business under, isn't it?
Yes, I think it's about a commercial rate, Roger. And I suppose one thing, we've done deals historically before the recent interest rate rises, which were the fixed percentage. And I think maybe the one thing to bear in mind is, given how things have moved so much over the last 18 months, you'd be well advised to think about, if you are applying an interest rate, tracking it to base.
Yeah. But again, there's no obligation to, is there?
You'd have to charge interest at all if you didn't want to.
No.
Okay. Just flicking through some of the other questions here. Comments. Sam Roden from HSBC. We support a good number of EO businesses, some with funding, some where all done on deferred.
I'd just probably say something on that. I mean, Sam, HSB are very prevalent in this market. It's fair to say there may be other bankers on here, and we'd be delighted to hear from them if they've got, you know, anything to say as well. But, you know, HSBC, I mentioned main clearing banks and funding. HSBC are very prevalent in this marketplace. So Sam will no doubt have a good deal of experience.
Yeah. Okay. I'm just wanting to see that we've got through all of the comments and questions. Neil again has suggested doing some kind of what if cash flow modelling exercise to enable owners to understand if they can actually afford to sell and disappear into the sunset or otherwise. And Neil always talks about, I'm not going to put it as eloquently as he can. He talks about sitting on a beach with a cocktail, or sitting under Blackpool Pier with a can of Stella, I think, something along those lines. So making sure that you can afford to retire for the value that you're looking to get. Let's just flick through these. I think we've answered all of those. If we haven't, our contact details will be circulated after this. So please feel free to get in touch with any of us with any questions that you might have. So just some closing thoughts, if I can. Keith, I'll just come to you just for a few thoughts, final thoughts around EOTs.
Yeah, sure. It's not for everyone, but it's another string to your bow when you're looking at a potential exit. And I think the key things to think about are, you know, do you have the right management team in place who can help it to continue to succeed? Are they suitably incentivized? And do you have the right structure for yourself in terms of the debt profile, not going to come under too much pressure? And have you got the right board? I think it's all those things.
Yeah. We've got a banker throwing the hat into the ring, Barclays, Paul Nichols. We've seen a lot of EOT transactions, some funded and some on deferred also. Hi, Paul, thanks for that. Claire, come to you for some final thoughts.
I think I'd just say, although the tax benefits are fantastic, they shouldn't be the driver for the decision to sell to an EOT. The conditions need to be right. The business has to be suited to employee ownership, and the stakeholders need to be aware that this is designed to be a long-term structure. It's not a quick sale and sale on again.
Yeah, completely agree with that. And Richard, just coming to you for some final thoughts from you, please.
Yeah, well, obviously the main point, there are more than one bank available, so that's something Paul's picked up, which is great. And for me, as I said earlier, I think it's about exploration, talking to people. Don't make a decision without investigating what other people have done. And in the EOT world, there's lots of opportunity to do that with advisors, the Employee Ownership Association. So talk to people, find out as much as you can. If this is the right thing to do, plan a little bit before you jump in.
Yeah. Right, well, thanks very much, everybody. I hope you've all found that useful and informative. As I say, our details will be circulated after this if you don't have them already. So feel free to get in touch if you want to chat through any of the aspects that we've discussed, to work out if this is something for you or not. We'd all be happy to talk to you about that. So we've kind of summarised what EOTs are, how they might be funded. We've talked about the bits around the edges, how they work in practice. And we've talked about the consultation that the Revenue have just launched, which largely we welcome. We're going to be feeding back on that. It is good that they're looking like EOTs are going to be around for some time. It's sensible that they're going to be closing some of these loopholes, thinking about that non-residence point that Claire talked about. And particularly, sellers are going to have more comfort now that they're looking to legislate on points that were just kind of revenue guidance before. So the contributions to the EOT, it's all sensible stuff. I hope they stick with what they're saying they're going to consult on. I think it's going to provide a great deal of comfort to sellers, and I think EOTs will be around for some time. With that, I'm going to say thank you to our panel, to Keith and Richard from Napthens and to Claire from PM+M. There will be a short feedback form, I think, which will be, I don't know if it'll pop up after this or if you'll receive an email. We'd be really grateful for any feedback that you might have about how we can maybe do this thing better, or just any kind of general comments that you might have. So with that, I'm going to leave you and thank you all for your attendance and contribution. And hopefully we will hear from you all at some point in the future. Thanks very much.
Thanks, everyone.
Thanks.